Takes good care of us.
All right. Well, welcome to this month's Capital Markets Update and Outlook presentation. We are, of course, live here in person in Eden Prairie. We also got a bunch of you online today, so let kind of the online catch up with us here in person. But just want to welcome you guys. Thanks for coming out. Appreciate you taking the time to be here. I know you all have busy schedules, so definitely appreciate that. Like I said, we're also live on our website, as well as on our LinkedIn page, Facebook, and YouTube as well. So if you are online live with us today, welcome. Thank you for being here. And then actually, I think we get a bigger audience in the replay. So if you are watching this in the replay, welcome and thank you for taking some time out of your busy schedule. If you are new here, my name is Eric Hagan. I am a financial advisor and I am president of Capital Consulting Group. CCG consists of myself, of our Chief Investment Officer, Tom Fox, who we will be hearing from in a minute, financial advisors Dan Oshman and Rana Grant, as well as our client support team, John Knudsen and Marilyn Westmark. Together, our goal is to help our clients make their next financial decision and the one after that a good one. We do this through personal wealth planning, where we can help you see your entire financial future, not only today, but throughout the rest of your lives, paint a picture for you. If you'd like to learn more about that, I encourage you to watch the 2-minute video at clearfinancialfuture.com. And then we help our clients get and stay invested right through our fiduciary investment management services. If you'd like to learn more about our personalized approach to investing, you can learn more at our website, smartmixportfolios.com. We keep our finger on the pulse of the markets and the economy. Every Monday, I broadcast live on our website and online, a short recap of what's going on in the markets. You can also watch this on our social media pages as well. And then about 3 o'clock Central Time, Monday afternoon, I email out a summary as well as our more extensive kind of update as it's an attachment to that email. So if you're not getting that email and you would like it, you can subscribe to that email at our website, of course, investwithccg.com. But today, we're going to hear from Tom Fox. Tom is going to review kind of where we're at with the beginning of 2023 here. He's going to talk about the headwinds, the positives, and then look to the future, which is what everybody wants to know, is where are we headed? Tom has a very impressive resume. He spends all of his time kind of behind the scenes, analyzing, researching, doing due diligence, really trying to understand where the markets are at, what the economy is doing, and how it all works together. So as you can see, very extensive resume. It'll take a while to read through all of that, wouldn't it, Tom? And so I'm going to turn it over to Tom here. We will open it up for questions at the end. If you're online, whether live or in the recording, please don't hesitate to post questions in the chat box. I will be monitoring that, and I'll bring those to Tom towards the end. And then, of course, for those of you here in the room, be ready to ask any questions if you have any. I'd love to address those. So with that, I'll turn it over to you, Tom. So thank you.
Thank you, Eric. It's good to be here. Let me get this on, the clip. Put it right here. So if I go brain dead at some point in this presentation, as I left Charlotte, North Carolina, and got here about 8 a.m. So yeah, you can work that out at what time I got up, Minnesota time, but it was really early. So I'm glad to be here with you today. And I think we're in exciting times for the 2023. So we're going to look forward to what we have and what we think is going to happen going forward. So the overall theme is wag the dog. How many know what that means? How many don't know what that means?
I assume it means we're in control.
Yeah, what it means is it's an idiom when something of lesser influence influences something of much greater influence. And in this case, that would be the dog, the greater influence. And then in this case, it's the Federal Reserve Board. Now, don't call Fed Chairman Powell and tell him I said that. But the lesser is the inflation. So we think inflation is going to continue to spiral down like we've been seeing And eventually it's going to cause them to pause. And then we had a little hint of that. We'll talk about that. So we think that's going to shift everything once the Fed's done raising rates. And we think it happens this year. We'll look at it more as we go through the presentation. Now, I like to talk first thing about at the beginning, I like to throw it right up front. And that is that there are a lot of negatives out there. And I've never seen in my career I don't know how many years I've been doing this, long time, but so divergent of views out there of really smart people. Now, I was just in North Carolina, and so I heard two money managers. One was Clark Capital, the other one was Raymond James, their CIO. And the good news is they agree with me. It's always good to find a few, but there's many people that think this is going to be a very negative year. And there's a lot of reasons. 3 months of CPI dropping will not convince the Fed. They need to see lower unemployment. That did not happen, especially in the latest jobs data, which we'll talk about. The Fed will continue to raise rates beyond 5%. That's the expected, is they're going to go higher than 5%, increasing odds of a deep recession. Not a soft recession or a weak recession, but a very deep recession, which would not be good for the stock market. The Fed will keep the ultimate terminal rate unchanged for an extended period. Once they get over 5% or wherever they end up, they're not going to drop it. They're going to keep it there. So they'll keep pushing against the economy. Corporate profit expectations are still too high, need to be lowered more. And the Fed, it's going to get tougher as the Fed gets closer to their 2% goal. They keep talking about 2% inflation, but it's kind of like when the Minnesota Vikings is getting down to the red zone, the defense gets tougher. And so that's kind of what some are thinking. The current market rally is only in a digestion phase. We've had a great beginning, but it's just a normal digestion phase, and it's not going to hold up. All the negatives out there are not fully priced into stocks yet. There are plenty of negatives. The recent rally is mostly short covering. Many people were short. We had this bull run here, this rally, and so they were forced to cover their shorts, which propels the stock market up. So it's not a long-term phenomena, it's a very short-term. Odds of a pause and return to more hiking will lead to higher terminal rates, not lower, like many are expecting. And many are expecting the PE ratio, forward PE ratio, to go down to 15, which means we would have more downside. Good economic news is still bad for stocks. Now it kind of flips back and forth, where we have a good jobs number, it goes up, or you have a good jobs number and it goes down. So but we've seen a run of economic data, good economic data, ends up being negative for stocks. Why is that? Because they think it's more pressure on the Fed to raise rates even further. Because if the economy is doing well, then the Fed's work is not being done. They're trying to slow everything down. And overall, there's deep skepticism. Many strategists see lower lows from October of 22 going forward. Now, we're not in this camp. Our glass is half full, not half empty. So we are more positive and more constructive. So if we go to the reasons, and I can find a lot, inflation continues to roll over hard. We're seeing that in all the numbers, and that's what we need. Fed finally admits, after the string of inflation numbers, the CPI, the PCE, all these numbers are pointing to a hard fall in inflation. And Powell admitted just recently at his meeting that he thinks that it's deflation. But is it enough? Well, we think that is a huge move towards dovishness. The U.S. economy remains remarkably resilient. We've had the third quarter, fourth quarter, we'll look at a chart. Last year, the GDP did really well. We haven't seen yet the crash in the GDP. Now, do we think we may go negative in GDP? Yes, we do, but it's going to be slightly negative. I think it's the third quarter of this year, but we'll see. Households the U.S. economy remains remarkably resilient. Households still in good financial shape. Now, if you look at the excess money that households saved during the pandemic because they couldn't go out and spend it. They stayed home. We all were a part of that. We didn't go out and eat. We didn't take trips. And so we saved a lot of money during that period. That's about half gone. There's still about half left, but most economists think that that excess savings is going to go back to normal by the end of this year. And they'll spend it all. Well, that's going to uphold the economy a little more because they'll have money to spend. They still do. Employment still seen as, so what we're looking at odds of a soft landing or soft recession next year. Employment still strong as in recent job data. Remember, we had 517,000 new jobs just reported. It was twice the expectation. Now we're at an all-time low in unemployment. Now that doesn't jive with a bad recession when you have that low of unemployment. Usually high unemployment is associated with a recession. Then we have China and Europe. They're going to start contributing as China restarts and Europe works their way out of their issues, but that's all going to contribute to the economy. It will contribute to companies in the United States that are global, that do a lot of business overseas. Corporate earnings were mixed in the fourth quarter. They weren't not a disaster. It was sort of industry by industry and company by company. We had some companies do really well, some not so, but it wasn't a disaster. It was mixed. US dollar is falling. If I got a chart on that, that's good for corporations that do business overseas, and a lot of them do, a lot of the larger companies. So as long as the US dollar keeps falling, that's going to be good for their earnings. It also is good for international stocks. And we're still watching that. They've done pretty well so far this year. And that is something we may pick up in some of our strategies, start to move towards some international stocks or groupings and indexes. But we're getting a lot of that from global companies that are based in the US. We also, strong beginning. This is interesting. This S&P 500 is, after a down year, if we have a first good beginning, it usually bodes well for the second half in the whole year, or the first half in the second year. And that's what we're seeing right now. And currently, this rally is validating the bull market playbook as a dominant force out there. A lot of the bears are wondering what's going on because the market's up pretty big. And we'll look at the next slide on that. So stocks market is still inexpensive. Downside is limited, but we believe we've already seen the bottom. We're not alone there. The fact the two firms I was just with, they have the same view. So I'm not the only guy out there on the island. All right, stocks are acting like bull market has already begun. There's evidence of this continuing. So we'll look at some charts. Well, this is what we did. Now, this was through last Friday. So it's gone down a little bit this week so far. But through last Friday, the S&P was up 7.86. The NASDAQ was up 14.77. That's a pretty good move in just a short period of time. Most people that were in that first list were not expecting that. So I'm wondering what they're doing now. We'll see. Here's how chaotic it can be. This is that when he spoke just recently at the Econ Club, this was his speech. They thought he was hawkish, but as he started answering questions, they decided he was dovish. And look at the volatility in the stock market just during an intraday. And as they listened to him, they go, this guy might be hinting I'd be a little more dovish than he has normally. Remember the Jackson Hole and subsequent meetings? He had a big fight with his wife before all those meetings, and he looked very angry. You know, he don't want to go near, Fed Chairman Paul. And I don't know what happened, at home those days that he spoke, but when he got up there, he wasn't. He was very hawkish. This changed in one day. I mean, that's a lot of volatility. So they first thought he was hawkish, then they decided he's dovish.
We're disinflation doesn't matter.
Yeah, exactly. All right, here's another positive. When you see high yield spreads, you see come down like this, relative to quality, spreads are improving. And that's a big drop. That's a monster rally in high yield bonds. And high yield bonds are the most risky bonds. So they tell us in advance, are we going into bad times? And it's just telling us the opposite. We're not going into bad times. So that you want to watch that one. So the NASDAQ almost hit its 200. That's a big deal. It hasn't happened for a long time. Since it's done that, you can see how it's been below the 200 for a long period, all the way back to last year. So that's a good sign. If it breaks 200, now it came back down this week, but it should continue, we believe, and that would be a good, healthy sign for the NASDAQ, which has had a big run, a monster run. All right, you can annualize just the beginning of what NASDAQ's done. We'd be up at 60% or something. I don't think we're going there. Now, here's interesting. Profit margins for corporations are stable. That means they're still making money. You can see how it's up at 11.2%. That's what it's been since 2012. Very high, but it's now stabilized too. It's not going down, not falling like a rock. So companies have found a way to lower expenses, to maybe supply chains are getting better, the prices are coming down. So they found a way to make money in a much more positive way than a lot of analysts were thinking. All right, so this is the US dollar. You can see it peaked here. And that means that international stocks would have a tough time, but it also means companies that do a lot of business overseas have that negative impact, that factor against them because of the high dollar for overseas. But now it's coming down. It looks like it's peaked. We think it has, and it'll probably continue downward for some time. Now, again, that's why we may be looking at international stocks going forward. Okay, this is, you have a good year. After a bad year, you typically have a good year. Now, the only time that didn't happen here in this chart was 73. We had 2 years down, but that was a terrible period. How many remember what the inflation rate was in 73 and 74? It was in the high teens.
My mortgage is 18%.
18% mortgage. So we are nowhere near that. We don't have the kind of crisis that was back there, or the great financial crisis. We don't have that. What we have, and if you look at it, the stock market typically, and this is where we are, will do very well after a down year. And we're going to look at some more fancy charts on this. But this, we think that increases the probability, at least based on history, that when you have such a negative year, it typically will have a good year the next year. All right, so we had a strong January, 6.4%. That's over here. The full year, we don't know what it is, but when you have a strong January of 5% plus, you have a 93% historical strong market this year, and averaging 23%. So when you have a good January, that kind of sets the tone for the rest of the year. And you can see by the numbers. So 90, how many know that that's better than Vegas? Somebody was talking about, what do you think the percent, a good blackjack player, what is their percentage win at a Las Vegas?
I don't know.
A good one. 47%. 47%. This, you got a 93%. I'd rather take this bet.
Yeah, so the goal is January, right? So
Yeah.
I'm looking at this, I see one January resulted in a negative year.
Yep.
So every other positive goal had a big blue.
It did. So these are good numbers. We had we do well typically after a bad year. We do also well when you have a good January. And then we're going to look at the trifecta. How many would like to see the trifecta? I don't know if that's the next one. Yes, it is. Now get ready. You better put your seatbelts on. Okay, when there's a Santa Claus rally, which there was from Christmas to the end of the year, and it was a positive return, you have a good first 5 days rally, which we did, and we had a good January. That's all three, those trifectas coming into place. When you look at it historically, if you get that, you have a really strong possibility of good returns. There's 17.4% average return for the year with another high probability 90.3. Now this is what 17.4, the median 17.3, and then the probability is 90.3 when this happens. Now, what's interesting, I have these boxes. This is when there was a recession, like we potentially could have. Return and negative earnings, 31.5 for the year. Another recession, minus 2.4 in the earnings, 23. That's about where we're going to be, we think. And you can see every year that there was a recession, negative earnings, the stock market still did very well. And remember, the earnings, the stock market bottoms typically about 11 to 12 months before the earnings bottom. So this shows you when you get that trifecta, which we had this year, we got a strong possibility of a good stock market this year.
I think
That's better than Vegas.
I have the number of people called concerned about the potential for a recession. And yet you're showing all four of those boxes was recession, and all four of those years was positive.
Yes,
And three of them had negative earnings. So
right.
it's still a good year to markets. Wow.
And one of the best years. Actually, the average is higher than the 17.4. Okay. Now I showed this chart last time. I think the last two times are presented, I've shown this chart. This is the stock market can rally before the Fed shifts their tactics. And in 1982 is the example when Volcker had been raising rates. We had a bear market worse than we had this last year, minus 27. This is where he decided to shift potentially, but the stock market had already moved in advance of it. Plus, it was 4 months before the whole bear market was, went away. In 4 months, they recovered the whole 27% in 4 months, erased it. So it looks like we're doing this. They haven't announced a tactic shift, but looks like we're already moving similar to 1982. Now, will it fall through? I don't know. But this just tells you how fast and violent the stock market can move up on any smell after a bad year, terrible year, when they see the Fed starting to shift tactics or perceive that they're doing that. I think that's why we got the rally. Have any questions on this chart?
We've been so focused on the recovery. Look at the following 2, 3, 4 years.
Yeah, just keeps going. Absolutely. All right, the economy. Let's take a look at some charts and data on the economy. This is interesting. Financial conditions are going the opposite way. If this line here is going down, that means financial conditions are getting better. It's credit spreads, stock market valuation, a number of factors go into it. But what this is saying that the Fed's raising rates, but financial conditions are getting better. For stocks do well when you have good financial conditions. They're loosening despite the high rates. This is unemployment. We talked about that 50-year low after the 517,000 jobs added instead of half that. So that sent this to an all-time low. This is healthy for economy. Now, it completely surprised every economist, the number that came in. Nobody expected that kind of a number of jobs that were added. And so it points, though, again, that this economy is probably not going to go deep when it goes deep. Now, there's layoffs happening. There's a little lag effect. We're starting to see a lot of tech companies are laying off. Some other industries are starting to lay off in anticipation of tougher times ahead. But this gives you a solid base to work from. Because if people are making money, they can contribute to the economy if they're getting a paycheck. Now here, this shows you the economy finished at 22 strong. These are the last 2 quarters. Remember we had that last year, that one negative GDP number? And people are saying we had a recession. No, we didn't. You can see it came back very nicely. So we ended last year pretty strong in the economy. Solid growth, no recession. We think we're going to be soft landing or soft recession. We've been saying for a while, soft and soft. No, I haven't heard anybody on cable news say that. Soft or soft. I haven't heard anybody say wag the dog. Probably never will.
I think softer stuff is coming.
Yeah, soft or
I
soft.
think they're
Yeah,
paying
because
attention.
usually, right, they come a little later. Is that right? Okay. Inflation falling like a rock. This is the whole key to the direction of the stock market. It's going to wag the dog. That's what we believe. We can see the PC deflator. Now, that's another type of inflation number. It's the preferred by the Federal Reserve, but you can see it's coming down. And it had a nice negative number, if you can see that in the lower right side. So real personal spending is starting to come down, and also is the PC deflator year over year. Now, that's an annualized number that on this chart. If you take the trailing 3 months, it's looking really good, and annualize that forward. So that you can do that with the CPI, and we're running out 3%, 2.5% inflation numbers. That's where it's going if it stays that way.
It's more of a newer indicator for people. What is the PCE?
That is, it takes into account a little different weighting compared to the CPI. And I don't have it exactly in my head, but it's something like, it's what consumers are actually paying, and it's a different model than this, but it's the preferred Fed. So you want that to come down because they like that one better than the CPI. They like the CPI, but this is a better one. I'll get the exact definition of the components. I just looked at it too. Just not that long, just today. I had it here for a while. I was up at 3 a.m. It'll come back. All right. Now this is interesting. This is the CPI, which is the dark number. And this is prices paid, wholesale prices, and then lagging them 6 months. And you can see when you lag those prices 6 months, the dotted line, that the CPI follows prices paid with a 6-month lag. So what this means, like you can see how well it did it here, how it went up and came down hard, and so did the CPI. You can see it follows a pretty good indicator, and we'll look what it's doing now. This is prices paid at the wholesale level, and that's eventually going to get to the retail level, what we pay. So that is rolling over hard. We think that's a great indicator. Inflation is going to continue. And even if you look at the subcategories, the drivers of the CPI, they're all rolling over. Even some of the harder ones, the stickier ones, are starting to come down. All right, so what is our actual outlook after all this? We think, again, it's wag the dog. Falling inflation, labor weakness shifts Fed to pivot. We got to see more earlier than expected. And we'll talk about that in just a few lines here. So we think the rally has already started. S&P was up 745. I think that was last through Friday. NASDAQ up 1422. Inflation continues to fall hard. This inflation will reach shelter and wages. And by the way, with that fantastic jobs number, wages came down, went from 4.8 to 4.2%, which is interesting. You have all these jobs, but the wage increase inflation was not that high as it was before. So that's what you want to see. Inflation falls hard, shelter. And so soft landing or soft, not session, but recession. You didn't fix that.
I didn't fix that.
Okay, you're supposed to catch that. All right, and 23, no deep recession. Whatever that is. So corporate earnings come in mixed. In the fourth quarter, we talked about that. They did not crater like many expected. Once the Fed slows or even stops rate hikes, we think May or June is when they're done. In fact, I just heard the CIO of Raymond James say the same thing.
You consider that a pivot or recession?
It's going to, stock market looks, remember in 1982, it runs, starts running before they actually do it. I think that's already started. So I think we saw that smelling it out. The investors are smelling it out. So I do think it will stop in May or June this year, which would bode well because now we know where we are in interest rates, and they're going to let all these interest rate hikes work their way through the economy. Because remember, it's like a ship putting the brakes on a big passenger ship. They got to put the brakes on way before they get into the port. So there'll be a lag effect, and they got to watch and see how it impacts the economy.
Or John's got life policy.
Yeah, you got to buy a house. Yeah, we got to. All right, so we think it's May or June, and we think the markets will rally once they know for sure. I think we've already jumped it, like we saw in 1982. All right, bond yields stay in a tight range for the first half. We are now 50% in fixed income. One of those positions is in a non-traditional fixed income, but we only had one small portion in fixed income all last year, but this year we're starting to build up back into fixed income. But we think it's going to be in a range. But the second half, we're expecting the yields to come down maybe to 3%. So we think fixed income is a place to be. And so we picked up AGG, the aggregate. We picked up MBB, MBS, and so
I don't understand that. It's gonna be down, it's gonna fall the second half of the year. Why is that good?
interest rate.
Bond yields are gonna fall?
We think the bond yields, the 10-year goes to 3%.
Peter House.
It's at about 3.65 right now. So you
fall, right? The value of the bonds go up. Oh, I got it. Yes, thanks.
so you kind of lock in the higher interest rate where you went in,
Yep.
and then as it goes down, your principal goes up.
Got it.
Okay, so we think there'll be a range of the first half, but it will be a great second half, and we think bonds are going to have a good year. They had a terrible year. How many know that bonds had a terrible year last year, like stocks? Okay, lots of cash still on the sidelines. What's that?
Nobody at Smart Mix experienced a bad year in bonds.
Oh, no, that's right. No, because we were able to maneuver through alternatives. So we didn't have the big drop that the bond market, we avoided the whole big drop. And that's our flexibility. I wanted to say that in the fixed/alt, we don't have to be in fixed income. We can go to alternatives and back and forth. So we're starting to move back this year to fixed income. We avoided most of it. We had a short-term high yield. It did pretty good compared to everything else. So we are now moving back to bonds slowly. Because we anticipate this is going to be a good year for bonds. So there's a lot of cash still on the sidelines. Stocks will move violently to the upside when that money, institutional hedge funds, say, hey, remember all the negatives we saw in the first chart or list? When those start to change, when they change their mind on that, we think a lot of money is going to go back in. When they start to agree with Tom, high probability of double-digit returns in 23 at the first sign of a pivot. Now we already have double-digit with the Nasdaq. And then S&P forecast is 4,600 by the year end. And we think the rally's already started. And our last thing is expect volatility, 2 steps forward. It's not going to go straight up and then a step back. So you're going to see it bounce around, but it's going to kind of keep moving towards a higher number. It's going to be very bumpy. That's what we expect. Okay. Any questions on this?
Yeah, that brings us to the end of the presentation. So for those of you online, I am watching the chat box here. There's a few places. So if you have any questions, now's a great time to put those questions in. I would love to get those to Tom for you. But let's start with anybody in the room. Anybody have a question in the room here? Other than the ones that have already been asked. Go ahead.
Now, can you speculate on how our market might be affected if China were to invade Taiwan?
Oh, it would be a geopolitical event, and we would go to the defense of Taiwan. I think the goal of the U.S. right now is to build them up with a lot of tech militarily. And that's what we're going to be doing over the next couple of years, is giving them resources so they can defend themselves. They want to defend themselves. If I don't think they're going to do it. A general was said that he thought it might happen in 25. We'll see. It's any time you look at geopolitical things, they're almost impossible to forecast. You just have to deal with it. But if it did happen, yeah, the stock market would come down. How long it would come down? Typically, it's a short move down, but it could be violent and then it could work its way back up, depending on the outcome or what's going on. But that is something that's a geopolitical event, very difficult to forecast.
Might be similar to Putin's.
Yes, we had a lot of things go down with Putin, and then it kind of worked its way up to pre-Putin. So it took a while. So that's usually how these geopolitical events work out. But I'm not going to try to forecast that. We'll let the generals do that, right? That's a good question, though.
Very good question, and I think what I'll add is that when things like that come up, Tom and I and those that we rely on, we're together really quick, and we're discussing what do we do? Does this warrant a change? Does it not? Right? Two big events, and they're not too far past here. We had COVID, right? That was peaking over in China, and then we had those two cases appear. I think it was in Washington. It wasn't long, and we were together, and we did make a decision that it was time to go defensive in the portfolios. And so that was a very quick move, relatively speaking.
Yeah, that was a geopolitical event.
Yep.
And we caught it the peak of the market. I think it was by a week we got out.
Less than that.
Less than a week.
Yep.
So we missed a lot of the downside. We didn't, you take out 20%, what did we take? 25, I think? 25% off the table.
Yep.
And then we had to work our way back. Well, there's a lot of unknowns, but we did act on that geopolitical event.
And then on the Russia with Ukraine and the invasion, we were together talking about that right away, and we decided not to make any changes based off of what Russia was doing. And so my point right now is to say we're watching very closely every day. And part of the weekly updates and this monthly more in-depth presentation is to communicate to you all that we are watching very closely and having those discussions when you're busy with life or busy doing other things. But again, we're always willing and able and ready to take that phone call or field these questions at things like this. So whether it's China invading Taiwan or who knows what the next thing could be, right? We've had health issues with Biden on the list for a while. There's a million things that can happen. I have charts and posters that show all the bad news that has happened over time and what the stock market has done. And it's to Tom's point, it's usually what's the reaction in the short term. And that's what we spend our time trying to do.
I just, one of the money managers I was with the other day showed a chart of all the long-term returns. I think it was 20-year returns of the S&P, the NASDAQ, or emerging markets. And they're all pretty good, the returns. And then towards the very bottom, I think towards T-bills, there was another bar, and it was what did the experience of investors obtain? And of course, the stock indexes did up here, and you get down to the lower returns, it was 3.6%. And you say, why is that true? Because people get afraid and they sell at the wrong time. So very few people, even Fidelity Magellan, remember that? Very few people got Peter Lynch's returns because for whatever reason, they felt emotional and they got out of the market. That's why you hire us, because we don't want to get our emotions involved. We're trying to look at data, make logical decisions. And but the truth is, the psychology of investors can go a lot of different ways. And there's a great chart, and it's by JP Morgan, has it. I don't know if you can even pull it up. It's in their list, their guide to the market. You have that?
On their website?
Yeah.
Yeah.
We'll see if we can pull it up. But it's a guide to the market. It's in the, JP Morgan Asset Guide to the Market. But there's a chart in there that shows each year what the return was for the year, and then how much the stock market intra-year went down. You can't believe I think it's like 12 or 13% the average drop in a particular year, but it never ends that way. Very low probability. It does occasionally, but most of the time there's always going to be during the year a drop, and people get nervous and they may sell or pull back at the exact wrong time. I've seen that over and over with people. And if you go to Warren Buffett, he says, when do you want to buy? When you see a lot of greed. Sell when you see a lot of greed. When do you want to buy? When there's a lot of fear out there. That's how Warren Buffett's made money. He buys when there's fear. He sells when there's greed. And it's just the opposite of what most people do. So we're here to help you not be emotional and to help you guide you for the long term. Now, we're not going to get it perfect, but we're gonna do our best to use what I've learned and Eric's learned over many years of doing this. I've seen a lot of markets. So I don't know if you can find it. Did you get it?
Well, I downloaded their latest guide to the markets, but this is their regular update.
Okay, it should be. We'll just see if we can pull this up. You'll see red, returns. It's
In a longer presentation.
no,
Or is it
well, it's in the
slide?
guide. In their guide.
This is their latest guide.
Okay.
So they call their like weekly update guide to the markets.
Yeah,
This is
that's
end of
it.
December.
Okay, keep going down. Now it would be in their equities. They got a lot of charts in here.
Yeah.
They're not popping up, so I don't even it's all blank. All right, we'll get that to you. We'll get that, and you can just study it because it's kind of hard to see it up here on the screen. We'll get that to you. Look at it, how much intra-year the S&P went down, and then where it ended by the end of the year. And how many times that happens, and then people sell or try to get back in. If you ever sell, I want to get out of the market, well, tell us when you're going to get back in. Because if you feel good about getting back in, you've missed most of the return. It's just the opposite. You buy when you're feeling the worst. Remember when we went back in 12.5%?
Yep.
And he goes, I guess this is what you feel like. How did you say it?
Feels too good.
But we took half the money we pulled out and put it back to work. And it was right almost at the bottom.
Wow.
So we went opposite. Nobody knew where the pandemic was going. Was it going to kill us all? But we decided, based on history and experience, to put half that money back in. And then we gradually put the other 12.5 in. But that was scary.
Yeah.
None of us felt, really good about it, except for
in history to look back on.
Yeah, it was a
Ours.
once in 100-year pandemic. However, based on what we've seen, we thought the risk reward was good at that point, and it was. Because it was, within 4 days, I think, of the bottom.
Yep.
And then it went on and on and up and up.
4 days early.
Yeah, 4 days early. I didn't catch it 100%, but that's too bad. Anyway, so we will make decisions. That's why we get paid the big bucks.
Any other questions?
Yes, Bob. I get confused because sometimes when this data comes out, people interpret it, some are positive, some negative. Doesn't seem to be any consistency, but I do have a question in your positives versus your worry. That in the positive, it says that the U.S. economy remains resilient, which is good. Households still in good financial shape, which is good for the economy. But then I go down to the worries, and you've got, if it's good economic mood, it's bad for stocks.
It's a temporary thing. You're not going to go off the cliff.
Why is good economic news bad for stocks? Is that what you're asking?
No,
Based on what I said. Yeah.
Good economy is good. Then on the negatives, he says the good economy is bad.
Because if the economy is not holding up, then everything crashed in, then we could go into a deep recession. It's the difference between a deep recession and a potentially soft recession. So I understand what you're saying. The economic news, you want it to be good enough so we're not falling into the abyss, if that makes sense.
It gets back to what I said.
Yeah.
at the beginning, because sometimes you interpret it's good, it's bad, it's good, it's bad.
Oh, that changes over a whole year among investors. Good news becomes good news for the stocks, or it becomes bad news, and that can flip around very fast. That happens.
Kind of like what you were saying earlier with the recession and bad news. Oh, what bugs me about the Fed is their stock, not stock, they want unemployment to go up a lot. They want wages to go down. And, we normally think of it's good when unemployment rate goes down and all that. And that's one of the things that maybe we're in an unusual time because we have so much government money come into it.
Mm-hmm.
And then we have so many people that are really taking themselves off work because we still have cash and whatever. So I don't know that, if the Fed continues on its old historical high movements, they're going to run into a wall. I think that's what everybody's afraid of. They're going to push us off a cliff when we don't really need to be pushed off a cliff.
Right, and that's in the worry category.
That's the needle they're trying to thread.
Yeah, yeah.
Yeah.
It's a tough job because they blew it on the transitory inflation.
Yeah.
Yeah. So they were wrong then. Are they going to be wrong again? That's two wrongs. And they go too far with the rates. But I think the dog's going to be wagged. It'll force them to, stop. And then we'll see. I don't think they're going to, again, drop rates right away. Some people are saying they're going to drop by the end of the year. I don't see that. It all depends how that impact of the rate hikes works its way through the economy and jobs. Right now, it's not getting to the jobs. It's starting to get to the economy, though.
Percent goal is realistic.
Some are saying, no, they're going to really go for 4 or 3. Is there going to be a hard rock 2%?
I don't know.
Try to land that boat, that ship right in the right spot. I don't think so. I think it's they say that, but I don't think they're going to get to it unless they just really crush the economy. And we don't know. But right now, it doesn't look like they're crushing the economy. So 4,600 by the year end, that's where we were last month. Some of these are the same because I think I did this presentation in less than 30 days. So we have some repeating there, but I had some new things in here too.
All right, last chance if you're online, you want to post any questions? I don't see any questions coming in, Tom, so I think we can wrap up.
Okay, and those were all good questions. Thank you.
Yeah. And again, for those of you watching in the recording, please feel free to post your questions, email me directly. We would love to follow up with you if you have any questions, so don't hesitate whatsoever. But with that, I will go ahead and sign us off. So thank you all for taking some time here out of your busy schedule to join us today for this month's weekly update or monthly update. We are scheduled for, I believe it's March 16th, but we'll put it on the website, or it should be on the website right now if you'd like to sign up for that. So we'll see you in about a month or so. So thanks everybody. That concludes today's call.
I think I've lost some weight.